Hi, everybody. This is good. This is good. I am excited today. We have a lot to go over. It's going to be really good information. I am excited to have everybody here. I just wanted to say again, welcome. This is going to be good. If you're watching, post it in the comments. Tell me where you're watching from. I'm really interested to see if most people are local or if they're watching from another place. So let me know that. But we are going to really be talking about Jerome Powell from the Fed, how he's talking about the Great Reset and what's going on with that, and how does it affect home prices, all of that, as well as inflation. It's there. We're going to talk about it. But just last June, we all know that the Fed raised the Fed fund rate by 0.75% and what that did to interest rates. And they're going to meet again at the end of this month, July. And there's talks about it being raised even further than that by a point. So what does that mean? We're going to talk about all that. And if you are a seller, make sure you stay tuned because we're going to talk about something, a new tool in the toolbox, right? Out goes the escalation clause, in comes something new that we are going to talk about. So make sure you stick around for that. We're talking about buy downs and we're going to really dive into that. So stick around for that. Just a reminder, if you've got questions, make sure you type them in the chat so that we can answer those questions as we go. And without further ado, I want to introduce to you my friend, Matt Ledoux. He is a lender here in Phoenix. He's got 19 years under his belt, so he is not new to this whole deal. He's seen his own ups and downs in this market. So I'm super excited to have you because you are going to help us break down some of this stuff that people want to know about. Because they ask me and I go, let's talk to the lender. Because I'm paying attention to the real estate market and you're paying attention to what the rates are doing every day. So welcome.
Wow, thank you. I'm so excited to be here. I've really enjoyed watching your shows, and I think you're one of the absolute best in our market in terms of breaking it down so people can understand. And I think you're also using the Crawford market data in amazing ways too, because people really do need to be educated right now. There's just so much going on, like you said, so many moving parts, so much misinformation out there, and sellers are obviously a bit worried with what's going on. And there are some great strategies that you and I are going to talk about today, Sean.
Right. So good. So let's first get started on this whole Great Reset. It's the big kind of hot button out there. Everyone's talking about the Great Reset, and what does that mean? Again, the federal fund or the federal fund rate was raised by 0.75 basis points just last month, and we saw the interest rate spike. So now they're meeting again at the end of this month. So they're talking about a full point being raised this time. And so why would anybody not think that the interest rates are going to do exactly what they did the last time and just spike again?
Yeah, it's amazing to me, Sean. I'm just a liberal arts major with a B grade average, but I've been doing this for a minute, and it's so funny to me because so many people that are so well educated don't understand the difference between the Fed funds rate and mortgage interest rates. They are two very different things, and we have to very quickly explain what is the Fed funds rate because people don't seem to understand that.
Yeah.
So essentially what the Fed funds rate is, it's a tool that our government uses to guide monetary policy. There's a committee called the FOMC, and the Fed funds rate is the overnight lending rate for US banks. So if banks want to lend money to another bank, that's the going rate, which during the pandemic, it was between 0 and 0.25%.
Right, which was funny. I remember when it went to 0 and I had people calling me and saying, hey, I need to refinance now because I can get my home for 0%.
Correct. Yeah. And like we always have the running joke saying, hey, we can get you a 0% rate. You just have to put down 100%. Right. Same thing. But no, that's banks lending to other banks. And what most people don't realize is when you go into a local bank, that bank doesn't obviously have to have all the money on hand that's on deposit at that bank. There's certain percentages that they require. So what happens is money's always going in and out. So banks lend each other money on that overnight rate. Okay. So because during the pandemic, we almost had negative inflation because people weren't leaving their house. People weren't out looking for goods and services, right? So now the opposite has occurred. So right now the Fed funds rate is 1.75% when it was 0 to 0.25. Okay. So now what we're seeing is we're seeing that number continue to rise. Now, why is that? Well, why do we even care about the funds rate? That's the question. Well, who cares? Well, the Fed funds rate is tied to prime. People hear the word prime.
Right.
What is prime? Prime is the Fed funds rate plus 3%. So that number, of course, keeps increasing right now. And that impacts consumers in a big way. Not on their mortgage, not on their mortgage interest rate.
We have a slide.
What's that? Yes, we do. So we see the prime rate is going to impact our car payments, small business loans, home equity lines of credit, also credit card minimum payments, the percentages that those are based on. So the concern obviously is inflation, and people are going to have higher payments on all of these items, right? Now, inflation in its very simplest definition, Sean, is just more dollars chasing fewer products, okay? Right. So we can look here and we can see that inflation directly impacts mortgage rates. And as I follow Barry Habib of mbshighway.com, he's been my guru for many years when I'm tracking mortgage-backed securities, which is what mortgage interest rates are based on. He has always told us that inflation is the kryptonite for mortgage bonds, which is what mortgage rates are based on. If inflation's a concern, it's going to hurt interest rates, okay? And the big thing that people need to get their arms around is usually bad news for the economy is usually good news for mortgage bonds, okay? And which means better interest rates. So it's kind of like, and when you were a kid and your grandma gave you a bond for $25 and like 30 years later, it's worth like $40. A bond has always been considered a safe haven. It's a conservative, safe investment where you're going to get a fixed return versus, say, the stock market where you can get, these wild potential returns. So usually on a daily basis in our markets, in our economy, you've got the stock market and you've got the bond market. And money is typically flowing in one and out the other. Mm-hmm. Okay. So when we hear inflation being a concern, money is typically flowing out of bonds, decreasing the value of those bonds, meaning mortgage rates will increase. So that's a big part of why we've seen interest rates increase at their fastest clip since 1998. Right. Because of inflation. And now the government's going to step in and say, hey, enough of these 0% rates, the Fed funds rate, we have to keep raising the rates. And what they're essentially doing is they are slowing down the economy because they're also trying to curb inflation. Right. And the mortgage bond market likes that news, and therefore mortgage rates are going to be better. So as you mentioned earlier, when they raised the Fed funds rate by 75 basis points recently, mortgage bonds reacted favorably to it because, yay, it's going to help solve this inflation problem, right? Because the government would love inflation to be at closer to 2% a year. Now, earlier this week, we got a report that came in at year over year. And you can put that slide back up. We can see here what inflation month by month. Inflation came in at 9.1% year over year, and the Dow Jones estimate was only 8.8%. Now, believe it or not, investors were not spooked by this. Mortgage bonds were not spooked by this. And as a result, we really didn't see interest rates really rise a whole lot. And then if you'll notice, mortgage rates, although they went up very quickly, Sean, recently, over the last month or so, we haven't seen any wild swings in rates because bond analysts, the bond market, they're seeing a bit of consistency with the Fed saying, hey, we're going to keep raising the Fed funds rate because we know inflation's a problem. We're working on it. We're working on it. Right. So our hope is on that chart, you can see is that we've had inflation increase almost as much as, which in June it actually did increase over 1% in a single month. And these reports that you get are year over year. So for example, when this report just came out, it replaced June of 2021, which was 0.9%, and then it was replaced with June of 22, which was a slightly higher number. So as we get to the fall, October is our anticipation. When you add the most recent 12 months together, Barry Habib at MBS Highway is forecasting that we should see inflation start to peak. And if inflation peaks, and now we have all these months under our belt of all these raises, then it's possible that we could see mortgage rates, who knows, maybe they drop as much as a point by the end of the year.
Well, and it's interesting that you say that, because more and more of the people that I'm reading and I'm seeing is that I am seeing people say that we could see interest rates kind of level off maybe later this year into the beginning of next year.
Yes. And the memes going around Facebook and the internet are, you want to marry the house, date the rate, right? Because as you know, you can get a fair price for a home. You know that interest rate, it could be very temporary.
Right. Well, and I mean, and that's one of the things I always talk to my clients about, when we're starting to look at houses, and, I ask the question, like, what have you talked to a lender? Right. And then if they haven't, it's well, what do you know about what you can afford? And they always throw out the big number to me, well, we don't want to pay over X. And I'm like, okay, that's great. But without talking to a lender to really dive into that and know, what does that big number make the small number, meaning your mortgage payment? Let's work on that, because although the big number can seem overwhelming, you might be able to afford more than you think, comfortably. I never tell anybody to spend more than they are comfortable with. But in your head, you might be thinking, well, $600,000 is the max. I can't spend any more. When in reality, what that makes your payment, you go, oh, well, with the amount of money I'm putting down, maybe, and then what the interest rates are, my payment isn't as bad.
And people always come and they say, how much do I qualify for, Matt?
Right.
And I'm saying, well, hold on a second. Do you know what you're asking here? Because there's really two questions we're asking. Number one is, what's the absolute max I can qualify you for and I can get your loan done? Or where are you comfortable? Because that's what we want to do, is we want to work together, realtor, lender, and find a home. And we know the parameters of how much money they have allocated for down payment, closing costs, et cetera, and try to drill it down and marry all of those things together.
Right. And so talk a little bit about the Fed's fund rate raised 75 basis points at the end of June. And like I said, interest rates spiked, and now they've kind of come down. And I feel like a lot of the people that I'm talking to, they don't understand why. Yeah. Like, wait a second, it's like counterintuitive, right? And it's like, again, like we just talked about, if they raise it again a point at the end of this month, everybody, I think, expects it to just go up again. But is that really what's going to happen?
Probably not. And one of the reasons we have so many booms and busts in our economy is that a lot of times our government is late to react. And then when they react, they tend to overreact. And essentially, a lot of the people that work and manage our federal monetary policy, there are a lot of academics, people that really haven't worked in the private sector. And you could read the quotes from last year. There are a lot of people that work for the Fed that were quoted last year as saying they weren't concerned about future inflation at all. And here we are in 2022, where we're in the Jimmy Carter days, right? And we're seeing this extreme inflation, and we cringe when we pull up to the gas pump.
Yeah.
I think I even found myself complaining about a Chipotle menu the other day. I'm like, this is ridiculous. How much am I spending for a burrito? The food cost is insane right now.
It is insane.
So when you think about all those things, right? Everything costs more right now, and I think we're uber sensitive right now to what a mortgage payment looks like. Now, last month, Fed Chair Powell said we were going to probably raise it 50 to 75 into July. With this inflation report, they might want to raise it 100. And if they do, the bond market will probably react favorably, meaning better interest rates. Now, if the bond market is expecting 100 and they raise it 75, well, then mortgage rates are not going to probably react favorably to that, because normally things are baked in as far as they're forecasting X. And if X happens, it's the status quo.
Well, and that's the same reason why when they first started talking about doing all of this, right? Before they had ever raised any of the rates, or the federal fund rate, that had not even raised yet, but they were talking about, when we have these meetings, this is how many times we plan on raising it through the year. And interest rates spiked right then, and they hadn't even done anything yet.
Well, if you notice, when we had our biggest increases in mortgage interest rates was before they actually changed the monetary policy. Now, they can say they're going to do something all day, but of course they could always change their mind.
Right.
But
well,
right.
Yeah. And that's, I think, the other thing that people need to realize too, is that, it goes this way and then it can reverse.
Yeah. And here's the thing about a mortgage is it really can be, purchasing a home can be a hedge against inflation.
100%. I talk about that all the time.
Yeah, a fixed payment. So I just want to give you an example here. So we're talking about prime. We're talking about people that, home equity lines of credit have been a fairly big thing over the last year, because people had these amazingly low 30-year, 15-year rates, and they don't want to refinance them, right? They just want to get a home equity line of credit. So let's just say, Sean, on July 27th, that they do raise the Fed funds rate a whole point. So if you have a HELOC and your current rate on your HELOC that you built a pool,
right,
and you pay top dollar like everybody else that's building a pool right now, let's say your rate was a good rate of, say, 6.5% was your rate. Well, if they raise the Fed funds rate a point, that directly hits prime, which most HELOCs are based off. So your rate's going to go from 6.5 to 7.5, just like that. The very next payment, without any announcement, really. It's just all of a sudden your payment's going to change. Same with your credit card payments. And again, car loans are absolutely, we talked about, are insane. According to Edmunds.com, the average new car in June was $686 a month.
That's crazy.
Insane. Used cars, $554. And here's the thing that just absolutely crushed me is about 13% of new car, feels like buying a home.
Right.
13% of new car buyers are going to have a payment of over $1,000 a month. I mean, I don't see a lot of Ferraris on the road where I live, but I don't know. $1,000 a month?
Me neither. And while we're talking about this, just a side note, right? If anybody's watching this, do not buy a car when you're in the process of buying a house. Do not. That's my little. I have to just, because it's happened to me in the middle of a deal, and I got the call that, hey, Sean, this is going to really be hard because your clients just went and bought a car. And I was like, ooh, what?
Yeah. The two biggest nightmares for a loan officer are the car purchase, or, hey, I decided to quit my job right before closing.
Like 2 days before closing.
They're like, hey, man, thanks for the house. I'm so happy I quit my job. Okay, well, yeah, it's going to be a problem.
Right. Let's talk about that. It's gonna be an issue.
Exactly.
Yeah, that's so funny. Okay, so how high do you think, I'm asking you to, forecast now. Okay, how high do you think rates are going to, get the crystal ball out. How high do you think rates are going to go up, and how long do you think they're going to stay up?
I think it's all going to come down to monetary policy. If the bond market likes the Fed being aggressive in terms of taming inflation, which I think they will be, then we shouldn't be looking at much higher rates. Now, we could still see year over year inflation numbers come in higher the next 2-3 months. Like we said, we may not really see much reprieve until October. Mm-hmm. So we could probably see rates increase a little bit, but as long as the Fed keeps raising the Fed funds rate, as long as they are doing their best to tame inflation and to, probably send us into a recession, those all are going to bode well for interest rates. So I would imagine, we hopefully will not see 7%. Maybe we might see the lower sixes. Maybe we see 6.5. I don't know. But my hope would be is that the Fed is on this. They're aggressively attacking this. They want to get inflation down and then slowly start to see improvement October, November.
Right. So, okay. So I want to pop this up because this was a comment made by Michael Boylan. Yeah, we are going to have a recession due to housing. A crash in the number of transactions will cause a reduction in GDP and an increase in unemployment. What are your thoughts on that?
Well, I mean, a couple things. Number one is we've probably just peaked in terms of having record low unemployment. I mean,
yeah, do you know what Arizona's unemployment rate is right now?
It was one of the lowest in the country. What is it now?
I just looked. I think it was last week. It's 3.2, and the national average is 3.6. So we are sitting at one of the lower unemployment rates, and all of the jobs that are coming here.
Yeah, and I think if you looked at the pandemic charts and looked at how unemployment obviously spiked at the beginning.
Yeah.
And then it was amazing that we made it all the way back, and then unemployment was even lower at some point. So unemployment has to increase regardless, no matter what. We've hit the lows. And if you look at historical charts, and I'm no economist, but according to Barry Habib, if you consider having record low unemployment numbers and high core inflation, that is a Molotov cocktail recipe for a recession. Okay.
Right.
So those are the types of things that will send you. And his algorithm says this is 100% chance of future recession inside 12 months by those things being a part of it. And really, if you think about housing has been such a pillar of our economy.
Well, and that's the thing that I look at. Like,
yeah.
I don't think that the recession is due to housing.
Yeah, no, I mean, there's a lot of things going into it. You know,
right.
part of inflation is you can look at picture of these ships stuck in ports, thousands of them.
Oh my gosh, I've seen them.
It's not really that the cost of lumber per se is that much more expensive, the lumber itself. It's the transportation of all these things, or chips, or we have delays in new builds. Like I imagine you probably have clients that have been building a home for way longer than they thought because they're missing some type of material for their roof.
The appliances have been big.
Appliances, and then when we built a house just over a year ago, and one of the big things for us was like, what about getting our cabinets?
Yeah,
because that was a really tough thing. And you hear people complaining about concrete and who's getting the concrete. And in Arizona, we've got the new big Taiwan semiconductor plant.
I did a video about that too, and the amount I talked to several, not just builders, but I talked to a pool guy that builds pools and rebuilds pools. And he said, I can't get any concrete. All the concrete was going to TSMC, all of it.
Yeah, it's crazy.
Yeah.
So at some point, these ships are leaving port, right? So that'll help get us on track. And then we'll have all these months of higher rates on a lot of lending, right? Just not mortgage lending, but these other things. So people will start to conserve their money a little bit more. There will be fewer dollars chasing these products. And, we won't have to pay $5 for a croissant at Starbucks, hopefully.
That's fancy, Matt.
And I think the croissants are smaller, by the way. Yesterday I was there and I was quite disappointed.
It's the truth. It's called shrinkflation. Have you not heard of this? Oh,
it makes total sense.
The cereal boxes were the ones that threw me. They're the same size this way, but this way they've gone from this size to like this size. And so you can't tell when you're looking at it from the front that it's a smaller box at a higher price.
It makes total sense.
Oh, makes me crazy.
Yeah, these big boxes, and you're like, the box is this big.
And then there's this much.
The food only goes up to here. Like, I know. Did we need the big box?
I don't. Don't get me started. Those are the
things. We didn't need the big box,
right? So I want to ask you something else about that. People are. I'm hearing a lot all over the place too. Are because interest rates have gone higher, right? The adjustable rate mortgage. Like, is the adjustable rate mortgage a good thing for people to be looking at because the overall rate on those is going to be lower?
I continue to monitor it. There are obviously ARM alternatives, 3, 5, 7, 10 out there that could give you a little bit of a lower rate.
Mm-hmm.
The spreads are not as big as they used to be historically. It used to be you might be able to shave off as much as 2 points on an ARM option versus today, where maybe you could get to a point lower, something like that. It could definitely be an option for the right people. And as a mortgage planner, I'm always reticent to put somebody in an ARM unless I know that they are protected.
Yeah.
Because that ARM, like to say a 5-year ARM, for example, if you had a retiree on a fixed income putting down 10%, nothing's going to change in their circumstances, then it's a little more risky of a product than getting something fixed in that can't change. But if you have someone that maybe has, enough liquid reserves that they could pay off the house if they wanted to, or, maybe this is a second home for them, but they're going to sell their home in another state they own outright, so they're ultimately not going to have a mortgage. It can certainly be a viable option. So it's been a long time since we've really looked at ARMs because we've been so spoiled for so long. And remember, one of the reasons that mortgage rates have also stayed so low for so long is the government has been manipulating long-term interest rates by buying mortgage bonds.
Right.
They could continually to support and prop up mortgage bonds. They're their best customer. And as they wind their purchases down, that also has a bit of an impact.
Well, and I really think that part of the reason too that people are afraid of the ARMs, or they get really like standoffish about the ARMs, is because they think back to 2008. Because I think everyone was doing a full rate mortgage. And that, I've talked about this too on my channel, like even though this market is so different than 2008, like we don't have the predatory lending, we don't have all of that other stuff that we had going on back then. That feeling for people is still visceral.
Yeah, the walls are up, right? Most
for
people,
sure, and they go, adjustable rate mortgage, I'm not doing that. There's no way I'm doing that because it's gonna adjust, and then I'm not gonna be able to afford my payment, and because that's what they think about. And these are a little bit different. Like back then, I feel like a lot of people were doing like 3 and 5/1 ARMs. And the majority of the ARMs that I've seen talked about more recently that have favorable rates are like the 7 and 10-year ARMs, which for me, if somebody was asking me like, hey, how do you feel about this? I'm more comfortable with a 7 or a 10-year ARM.
Correct.
Because I don't know anybody that's had a 7 or 8 years or 7 to 10 years on their mortgage as a whole.
Right.
They refinance.
For example, there are some jumbo investors, by jumbo meaning you're borrowing over the cap here in Maricopa County of 647,200. They have some wonderful 10-year jumbo ARM products out there. So it could definitely be a good option. Now, when you look at 2008, though, you got to remember a lot of those ARMs, they allowed 100% financing. That means 0% down.
Totally.
And they were interest only. So you weren't paying down your principal as a hedge against the value. Oh, and we also did this crazy thing called stated income where you didn't have to document your income, and I'll just tell you how much I make. Does that work?
Oh yeah. Right. Oh yeah.
And so back to your point, the ideal home buyer in this country is about age 33. And they may not have gone through directly themselves, of course, the housing crash, but most likely somebody they're related to did. So people's walls are up and they hear that phrase ARM and they all of a sudden think subprime.
Right. Totally.
And that's not fair because that's really not it. You have to remember all the other things. Like if you watch the movie The Big Short.
Yeah.
I mean,
well, and so I just put this one up on here, and Jose, thank you. Instead of an ARM, have the seller pay $10,000 to buy down the rate. Stay tuned. We're going to talk about rate buy downs.
Yeah, absolutely, Jose. Thank you for bringing that up because we have an interesting strategy that we want to talk about.
Yeah.
Instead of just perhaps maybe even paying closing costs.
And here's another really good one. It's all crashing. It's all crashing.
Yeah. Well,
what do you say about that?
Obviously, I think Michael Orr of the Crawford Report said it well the other day. When people make a decision to do something, everybody wants to do the same thing at once. So
they're making a decision out of fear.
Yeah,
that I've heard Tina and Michael talk about a lot. It's like you can't make decisions off of your emotions. You have to make them when it gets crazy like this. You really have to look at the data and let the data help you drive your decision, and not how you're feeling about it, because it's just too easy to let that happen.
Yeah, and can we have that slide that I sent you about the news reporting?
Oh yeah, that's a great one.
And again, I'm not trying to say there's nothing bad happening out there, but I think we have to take some a grain of salt. So one of the most well-known real estate reporters in the United States is a very educated woman named Diana Olick. Okay, and if you watch MBS Highway, he will make note of many of her past comments. And I just want to show you guys this chart. So 2015, she talked about a bubble larger than 2006. What happened over that next 12 months? Home prices nationally went up 5%. 2016, we're in a new housing bubble. Home prices went up that next year 5.4%. 2018, better rent than to buy, today's housing market. Next year, prices went up 4%. Now, imagine if you listened to her in December of 19, where she said next year will be hard on the housing market, especially in these big cities. You would have lost out on 16% appreciation. So obviously, if you keep saying there's a bubble and you say it for 10 years, you could potentially be right at some point. But obviously, you have to also understand is what gets clicks, what will get views. Positive news will never get good news.
Right.
So
I'm so glad we calmed your nerves.
Yeah.
I just had to talk this up.
Let's talk about crash versus correction here. Okay. So if you're one of my clients that I'm so happy for that I got you in, say, through a down payment assistance program 3 years ago, right? We're all happy. We got it figured out. They clawed together $5-6 grand, whatever. And now they made, $200,000 in equity on their property. If the value went down 5%, is that really the end of the world for them? It's really not. It's not that big a deal. And you're also paying principal on this loan because you're not in a 2008 interest-only loan.
Well, it's I just one of Tina's charts, and I have this coming in a video where our overall appreciation, it has dropped here in the Valley.
Mm-hmm.
It's dropped by 4%, but it's from when you look at June 2021 to June 2022, you would have seen about a 20% increase in your appreciation. But if you look at July from 2021 to July 2022, you're looking at about a 16% appreciation. And that's your 4% loss. So unless you bought within the last couple months,
Well, and people are spoiled. The people that, made a lot of money on cryptocurrency in a very short period of time.
But then lost it.
Real estate is not something you should be looking to purchase for a 12-month investment, because Tina's got a great chart where she shows, hey, if you bought a home 20 years ago, and even if you took the good with the absolute crash and the rise and stripped it all out, you still made an average return of like 4 to 5% annually.
Year over year. So not 4% total.
Yeah. The example is like if you fell asleep in 2001 and woke up with a beard in 2021, you would have been quite happy with what happened, right?
Right.
So you have to factor that in as well. Not to say that because prices have gotten so ludicrous, I just helped a client on a new manufactured home in Tonopah, and it was fairly priced at $350,000. Mm-hmm. I mean, I look at that now and go, well, that seems like a lot of money to spend on a manufactured home in Tonopah. But that's what the market has been.
Right. Well, and I think that goes back to some of the things that we were hearing, when the market just kept climbing and climbing and climbing. And I'm going to pop one of these other comments up. Too early to buy. Phoenix will crash hard. The local economy doesn't support prices in that market. Wait for a 40 to 50% decline. We just talked about the employment. We're at 3.2%. Nationally, they're at 3.6%. So our unemployment is lower. But what I was going to say was that they talked about all this. We're at a new normal. And I think that people that were kind of buying into that new normal are now afraid that, oh my gosh, maybe it wasn't the new normal, and maybe it is a bubble that's going to burst. But what I think this is, again, what I talk about, it's like it has gone up, and we could not continually support that increase year over year over year appreciation. We just can't.
Well,
and it's going to settle, and
I
then
mean,
we're going to be flat, and then I think we're going to see a little bit of an upturn again.
right, and obviously a 45%, 50% decline. It's a pretty big number.
A very big number.
Yeah, and what's going to tell us that we have a problem is if we see mortgage defaults increase greatly.
And we have not.
And we have not. And we've been at very low numbers. And what's really interesting is we had a lot of people during the pandemic that said, hey, when people come out of this forbearance program, we're going to see massive foreclosures. We didn't.
I know.
We saw almost none. And the very few that even hit in our market, they just got scooped up because we still have such a lack of inventory.
Right. And people are like, they feel like they're getting the best deal for it. And that I think is the thing. I saw this at the end of our last crash with the short sales and the foreclosures and things like that. Because in the beginning, it was like the banks were trying to figure out what they were doing. And so they were almost, I don't want to say giving homes away, but they were really like accepting like almost any offer. And then as we got to the end of it and prices were starting to increase, what I saw were banks were like, absolutely not, I'm not taking it. I'm not doing it as a short sale like that. I'll take the house back and I'll make more money on it.
Right.
And so it's just an interesting thing to watch and see. Yeah. So Jose, my home in Gilbert went up 320,000 from 2016 to now. Yeah, that doesn't surprise me.
That's not a bad investment, I don't think. You can safely say that's good. And here's the thing. What if you turned around and your house had actually not gone up 320, it had only gone up 290? Would that be so horrible?
Not at all.
Probably not.
Right.
And then, okay, I have a tenant till February of 2023, and then I want to sell. Okay.
Yeah.
Well, I think the good news is we probably will see rates start to decrease a little bit. So that's going to help your ability to sell. And this is probably a really good natural segue into what we're talking about. So if we want to help you with a potential selling strategy, and also Jose asked about it too.
Yeah. So let's talk about that. So sellers, this is the time for you to kind of tune in, really listen, because we are going to talk about something I've talked about this on my channel as well. We've seen homes now sitting on the market for longer than like 2 minutes. They're sitting on the market for like maybe 10 days, which in the grand scheme of things isn't that long. But the only thing that sellers feel like they have is they have just a price reduction. And so we've talked about this too. We've seen our price reductions spike, a lot of price reductions. But there's another tool. There's another tool that we can utilize that will help put more money in your pocket as a seller and give the buyer what they're looking for, which is a lower mortgage payment. And that's the rate buy down. And I talked about this on another video of mine, because this is what new construction is doing a lot. They're doing these rate buy downs, and how can they help their buyers get in without having to pay these exorbitant interest rates and keeping their payment low. But it's a 2-1 buy down. And I just want to pop this up so that, again, when we talk about this, and whenever I talk about this, I always say, talk to a lender, talk to a lender, talk to a lender, because they're the ones that are going to have the numbers and have all of your information so that they can give you accurate information about what your numbers look like. So Matt, you're here. Let's talk about this 2-1 buy down. It's a great.
Yeah, and I want to back up just for 1 second, because we're so spoiled in the last several years in our market. We forget that a balanced market, historically, a home could be on the market for 3 to 6 months. And we're not talking about luxury. And I know that you've done a lot of luxury in your career too, Sean, where it was normal for a multi-million-dollar home. It was more like a 12-month expectation to sell a home, right? So we're in a normal market. Now, as we shift to a balanced market, what does that mean? It means things are coming back, like seller concessions, people accepting contingent offers, sellers fixing everything on the Benzer, which is the report to have all the items fixed in the home. So now, with rates being elevated and sellers willing to make concessions, 2-1 buy downs, which were a thing over a decade ago, are coming back. And here's what it really does. It helps you get way ahead for at least 24 months, okay?
As the buyer.
As the buyer, And it's a win-win for the seller because they're probably giving away less than what they would do on a price reduction. And I know,
So,
Sean, you chose this price for a
yeah.
specific reason.
So I was just going to say that. So we looked at this price point because this price point is about the 2,000 square feet to 2,200 square foot house here in the Valley. Now, the median home price right now in the Valley is about 460, but at this price point at 550, we're at about that 2,000 to 2,500, 2,200 square foot home. So I wanted to kind of break that down and show you if you did a 2-1 buy down, what does that mean? And two, how much is it going to cost the seller? How much is it going to save the buyer? And then I'm gonna just jump because I get impatient. I just want to show you this. When we start talking about this, this is what the normal price reduction is for that house, which is $18,000. That's what that same home that we're talking about in that price range, in that square footage, their normal average their median price change right now is $18,000. So let's go back and just look at this. And now, Matt, break this down and explain how this works. And this is how much the seller is only going to spend, but so they're still going to make money.
That was a great chart you just showed us, because essentially what we're doing is we are netting the seller almost 50% of that. Right. Because if we're giving away 9,600 instead of 18,000, that's more money in our seller's pocket. Right. So this is just an example. I'm not obviously quoting an exact interest rate, current market. There's a lot of variables, et cetera. However, what I will say is if you use this example, just so that you guys understand how it works and what a great option it could be. If the current market yielded a normal 5.75 interest rate on a 550 purchase, someone putting 20% down, all right? The normal principal and interest payment would be $2,567 a month. So just under $2,600 a month, plus, of course, taxes, insurance. And in this example, we put down 20%, but if you put down less, of course, you'll have mortgage insurance as well. So basically what the seller is doing is they are giving an amount to subsidize the buyer's payments for the first 24 months. Okay. All they're doing is basically subsidizing it by saying, hey, instead of paying 5.75, you're going to pay 2 percentage points less year one. So your rate would only be 3.75 instead of 5.75, which is going to save you about $530 a month for the first year. So now you look at it and you say, okay, well, now I've got a P&I of 2,000 plus throw in taxes and insurance. It's going to give you a pretty reasonable payment that we were accustomed to, right, for a couple years. And then in year two, it goes up 1 percentage point, and it's still going to be a better payment than the fully amortized, which is in month 25. Okay. So you might say, well, that's great, Matt, but what happens at month 25? Well, a couple things can happen. So the money, the 9,600 is going what's called a custodial account. So it's your money as the buyer. It's just sitting in there for you to use. Now, if you look at everything we've talked about on inflation and potential looming recession, the chances appear to be very, very good that in the near future, most likely inside 24 months, but let's conservatively call it 36, there should be a refinance opportunity. Okay. So it leads me to Jose teed it up perfectly for me. Is there a penalty? No, it's your money. Jose, let's pretend here for a second that if you were to purchase the home, the seller pays the buy down, and in 12 months from now, you get a call from your loan officer, Matt, that says, hey, guess what? Interest rates have dropped over a point. I could get you a permanent interest rate of 4.5%, for example. Only 12 months have passed by, and the seller had subsidized that $3,264, right? So here's what happens. When you go to refinance and we go to pay off that loan, we're going to reduce the payoff by the amount that was sitting in that custodial account of $3,264. It's your money. So here's what's great about this. So people are talking about permanent buy downs. Well, let's just say for the sake of argument that if you pay 2 percentage points in discount, maybe your rate is 5% or something in that ballpark. But if you plan to refinance out of it in a couple years anyways, it would have been cheaper, at least on a monthly basis, to have the 3.75 and then the 4.75 for year 2. Now, are there any promises made on this that we know what rates are going to do? No, of course not. But what we can do is we can make a very educated guess. We can also go back to the 1970s and we can see, hey, when rates have increased this fast in this short a period of time, they've always returned to prior levels inside 2 years. We can also say that recessions have always teed up lower long-term rates. With that being said, if we're pretty darn close, there should be a solid refinance opportunity.
And for the sellers, just take a look at the difference. So the seller's contributing $9,624 here to buy down this rate so that then the buyer is getting these lower mortgage payments.
Correct. So
I went the wrong way. Or you can do a price reduction at $18,000 and hope that you get a sale at that point.
Right. So let's just say you have a tenant in place till February. You're only giving away 1.75 in this example. On a regular conventional loan, you can give up to 3%. So you could allocate that remaining 1.25 to pay their closing cost. You could use it for an additional buy down. There's a lot of ways where maybe you have a young first-time home buyer who's a tenant, if they can either use down payment assistance or scrape together their 3% down payment on a conventional or 3.5% FHA, then you can sell the home. And absolutely, Jose, this makes so much sense for both sides. Everybody's winning. Everybody's winning.
I'm so glad. Because this is one of those things. When I first got in the business back in '98, the first experience that I had with rate buy downs is when I was selling for DMB up in Flagstaff, and so we did a release of just custom home sites. Right, it was not even, there were no homes on it, and the interest rates were 8%. And we got together with a lender and we did permanent rate buy downs on this, and they were bought down to about the 5%, and it worked so well. So that was my first experience with it way back when I first got in the business. And so when people start talking about these rate buy downs now, I'm like, yeah. I mean, it makes it really is a win-win for everybody, because the seller's still making more money, netting more money, and the buyer's getting exactly what they want, which is a lower monthly payment.
Right. And again, we're looking at real estate as a long-term hold, a long-term investment that should protect us. We're paying principal on all these loans these days. So we know we're lowering our balance. And, historically, the government would like home prices to only go up a few percent a year. They don't want home prices going up 30% a year.
Like we have for the last 2.
Correct. So it's, people are just spoiled, and they're disappointed if home prices went up 5% a year. That's really good, because real estate, we're getting to leverage a much larger amount. You're putting down 5% on something that costs $400,000. Well, you're getting all the return on whatever the increase is over $400,000, regardless of the fact that you only put 5% in to begin with.
Right.
And it's the reason why how most Americans accumulate their wealth is through real estate.
Which is the other thing that I'm going to dive into in another video about what's going on with our affordability here, because and again, we talk about, and I've talked about this, the inventory increasing. So I want to pop this up too. So increasing inventory is only part of the problem. Since the home values went up 45% in 2 years during COVID, it's a mega bubble waiting to burst. I mean, again, to me, this is that visceral response of 2008.
Yeah, agreed. And I don't know, I haven't tracked it, Sean. I know we're looking at maybe 1,000 listings in the last, I don't know, a couple weeks or
we've had quite, yeah. I mean, it's definitely increased. Our inventory's increased.
They're to healthier numbers. Our numbers have not been healthy at all.
No.
And some of these are the iBuyers. Some of them have a lot of inventory on our market that's increasing as well. Open Door is obviously a topic of discussion, and that they have, I think, maybe 1,500 listings in the Maricopa County, Pinal area right now for sale.
Oh, say that again.
I'm saying, that Open Door has like 1,500 or so listings.
Oh yeah, it's crazy the amount of listings that they have. So yeah. So Jose, if I can rent my Gilbert home for almost $1,000 more than my mortgage, how long before I can claim that extra $1,000 per month added to my income so I can buy my next property?
Okay, so if it's currently your primary, Jose, and you're going to convert it to a rental on a conforming loan, if you get an actual lease agreement, what they're going to do is they're going to let you use 75% of whatever your actual gross rent is. Okay, so you're not going to get extra credit in terms of more than your payment, but it is possible to offset for qualification purposes what your mortgage payment is. So if you're getting $1,000 more than your mortgage, my guess is take 75% of that. It's going to at the very least, cover your existing payment, which should help you qualify to purchase something else.
Okay, so yeah. Do you guys see the increase in inventory flattening out? I do.
It has to, because, again, just like rates jumping up so fast and then they've kind of paused, same thing with inventory. It was a glut of inventory that was ready to hit the market. And I think Tina uses a really good explanation of the bathtub.
Yeah.
It's not necessarily that homes are flying on the market too. It's also that we're just seeing less drain out of our market.
Exactly.
Right?
Well, and that was, I just talked about that with somebody else. I just said, the reality is that even when our market was crazy, we had inventory coming into our market. It was just going out so fast. And now it's coming in and it's just not going out so fast. But the other thing that I'm noticing is, and I just saw an article yesterday about this, is all of these new builds they're all saying, with the rate buy downs, like we just talked about, they're all trying to do their quick delivery homes, right? And what I've started to see is that they're really starting to not build very much currently. They're kind of stopping any new construction and they're finishing out what they've got on their books, which right. When our inventory starts to slow again and our market changes, because it will that just exacerbate the problem that we just came out of with low inventory?
Right. And you have to understand, for builders, some builders, they might be on a program where they're financing, expecting it to be off their books in 18 months or less. So they have to be really careful to balance their existing inventory.
Right. So in 2012, 26,000 inventory is what was considered balanced. With the influx of people, is that still the balanced mark? That one's a hard one to answer, because in 2012, it was a long time ago, but we would see normally on our inventory how many homes we have on the market. I mean, we could see 40,000 active listings on the market. And then during the last year and a half to 2 years, we were at like 4,500 to 5,000 on the market. Right. So we're now back up to like 14, 15,000 on the market. And it's just, they're selling more slowly. And it's funny. I hear a lot of real estate agents talk about 6 months inventory means that we're in a seller's market, which there's validity to that. But it's really, I think, how quickly they're coming on and going off is a lot more it's a better metric, I think, to use to look at the health of the market overall.
Yeah. And I think, sorry, it kind of just made me think of where really good real estate agents, I think like yourself, Sean, markets like this are more ideal for people like you, because when you're more of a balanced market, it really allows you to maneuver a lot more in terms of the sales side or the purchase side, versus the craziness where we were in it, where sellers had all the power.
Right. Well, and it's the conversation that I would have with my buyers all the time during these last couple of years, is I would say to them, I'm like, understand this is not how I normally negotiate, but my only tool that I have for you right now is to take every one of the things that I would maybe hold back and throw them all out on the table.
Right. So the ability, right.
Yeah, I have to throw everything on the table and present you as the best buyer out there, known to man.
Correct.
And now I can hold stuff back so that we can negotiate and make it more of a win-win for both buyer and seller, rather than just saying, here, seller, I'll do whatever you want me to do. And here's what I need. Here are all my needs. What are your needs? And I'll match them and go above, really.
And what we're hearing from veterans that have been doing this for 30 years in the real estate community is they're pretty ecstatic about the market that we're in, because they can win for both their sellers and their buyers in a market like this.
Yeah. I mean, nobody likes change. That's the reality. That's where we are. And I think we're in that. A lot of people are afraid. It doesn't help that, like the chart that we showed before with the bubble, it's crashing. Everybody's talking about it. I do think I'll stand by what I've said in every one of my videos. I do not see a crash. I see a correction, and it's very different. But until we see massive job loss, we're not going to see a crash. I think people are going to start pulling back a little bit more financially because things are just more expensive.
They are.
But they can still afford their house.
Agreed. And I think we will actually, because refinances are not really a thing right now.
Right.
I think as rates drop into the year spring, we'll probably see a lot of people go through that debt consolidation as well, because they've made so much money in their homes.
Yeah. So is a correction a decrease in prices or a deceleration in prices? God, to me, I'll answer this for me, and then Matt, you answer. To me, that depends on what your definition of decrease or deceleration.
Yeah, it gets really complicated, right? Because you can say, okay, well, this house just set a massive record in the neighborhood, which was ridiculous to begin with, and now the next one sells for less. Is that really a decrease in price?
Right, because maybe the house wasn't on a desirable lot. It didn't have a view. It didn't have the same upgrades. It didn't have, all of those things matter. So, I mean, again, do I see prices decreasing? I'll be honest, I do. I see prices. I do think we're going to have some price decreases.
Agreed.
But they're not going to 40 to 50%.
Yeah, and like Tina at the Crawford Report always talks about is forever it was dump your junk season, right? Where you could have 27 cats and a filled up garage and an episode of Hoarders, and they could sell their house for top price. Well, that's not going to happen anymore.
Right.
Located on the freeway, or you could sell that house before. Now you can't. So is that a decrease, or was it maybe a little bit off to begin with?
Right. And it's funny because some of those houses, like we talked about just earlier with Open Door and OfferPad and all of those houses that you just talked about, backing a freeway, on a corner, backing a busy road, needs all these updates, all of those things. Those are the ones that I saw sellers sell to those guys because nobody else was buying them, even in a hot market.
Yes.
And now those are the houses that they're trying to sell, and they can't sell them.
Correct. And that's where, if you're a buyer that necessarily you struggled because you couldn't pay above appraised value, you couldn't pay for your own closing cost, this is your market. Mm-hmm. This is your opportunity right now. If you can beg, borrow, steal to cover that down payment and you can afford that monthly payment, you can get the rest taken care of. There's 2-1 buy downs that we showed you. There's seller paid closing costs. You can pay fair market value. There's tremendous opportunity for those people that were somewhat squeezed out of owning a home before.
Very much, very much. So to buyers, really, don't be afraid of this market. I know it can sound scary. It can feel scary, but if your situation is right, then don't be afraid of this market. If it's not, then don't buy. I said, do not buy. I've got somebody that I was just talking to the other day. She said, do you think this is the bottom of the prices? And should I buy right now? Well, her situation is that she still needed to save more money. She still needed to do some stuff. And I said, no, for you shouldn't buy right now.
Right.
And she was like,
if you look at, it's not like rent is dropping, right?
No.
Rent is getting more outrageous, and there's still a significant lack of inventory for rent. So for a lot of people, and they know they're going to live here and they feel good about their job, the answer probably is to own versus rent.
Right. Well, I mean, it again goes back to what you said and what I've always said. It helps grow your wealth over time.
Correct. It's a tool. It's a tool to accumulate wealth. 100%.
Right. Well, guys, I thank you very much. I'm going to pop Matt's information up here because he is awesome. If you need help with a lender, if you've got questions, he is great. Give him a call. There's his number right there for you. I appreciate you guys tuning in, participating. It was awesome. As always, if you have questions, please feel free, post them in the comments down below. You guys know how to get in touch with me. I thank you for watching. Bye, guys.